Yeah, welcome to ShareTreck, where science meets investment, and I'm your host, Raj. In this video, we are unpacking a question that should concern each and every investor, especially retail investors like you and I. Question is, are the numbers we rely on, numbers about GDP, inflation, unemployment, etc., are they really telling us the truth? And more importantly, what happens when policy moves much faster than data? By the end of this video, you will understand why tariffs might not possibly show up in economic data as of yet, and how revisions can quietly change the narrative months later. We have seen this movie before, and also we'll be talking about why stagflation risk is growing in 2025 and what we as retail investors can do to protect ourselves. So that said, let's get started. Welcome back, friends. So this is my personal opinion of what is happening and how I'm approaching it, and I'm eagerly looking forward to your feedback. Please put it in the comment section. I think the US economy in 2025 sits on a fragile edge. Inflation is hovering around 2.4% as of May, and the Fed is cautiously holding interest rates between 4.25 and 4.5%. At face value, that sounds stable, but underneath, the foundations are shifting. President Trump's second-term economic policy has taken a sharp protectionist turn, most notably with sweeping tariffs announced in April 2025. While these tariffs are marketed as boost to domestic manufacturing, many economists are warning we are risking a self-inflicted wound, potentially leading to stagflation. That's the toxic combination of stagnant growth and rising prices. The worst part, the damage from these policies isn't even visible in the data yet. Here's the kicker. Q1 GDP came in weak, showing a decline, but that data only reflects conditions from January to March. The April tariffs, they are not even in the picture yet. The time lag is normal. Economic shocks take months to work through their way through the system, through the supply chain, retail inventories, employment, and consumer prices. But it creates a dangerous illusion. People hear GDP is only slightly down and they start thinking that things are manageable. But that's like judging the weather with yesterday's forecast. To make things more complicated, the Bureau of Economic Analysis routinely revises its data. The Q1 GDP decline, it could be revised downward again or even up. The revision history during a COVID-19 crisis or 2008 crash shows how volatile early estimates can be. Markets move on these numbers, but the numbers themselves are moving targets. So what does this mean for you and I? Well, retail investors operate with far less cushion than institutions, and when economic data feels solid but is actually fragile, it becomes a trap. We base our decisions on data that hasn't been caught up to policy reality. So let us break it down. Tariffs raise costs across the board: materials, shipping, components. Those costs don't instantly show up in inflation indexes or earnings report, but when they do, the reaction can be violent. Market drops, earning misses, consumer pullbacks. And if you're holding a portfolio built on confidence in current data, you're literally flying blind. Add in political noise, daily tariff headlines, Fed policy rumors, court rulings, and you've got volatility on steroids. We have already seen markets plunge after tariff news, only to rebound on vague negotiation talks. So far, a deal has not been struck with any country to the best of my knowledge. Friends, I'd just like to request you that if you're finding this kind of a video useful, please take a moment to press like, and don't forget to subscribe to ShareTreck for grounded, globally aware investing insights like this. That said, I would like to talk about how we can get ahead of the data. Let us start by understanding what is lagging and what is leading. Lagging indicators consist of GDP, unemployment, inflation, and leading indicators consist of the Conference Board's LEI, which is already down, freight volume, purchasing managers indices, semiconductor orders. As of June 2025, leading indicators suggest weakness ahead, especially into Q3. And that's exactly when the full force of April's tariffs is expected to hit. So don't let stable inflation lull you into complacency. The storm is still offshore, but it's coming. And this is my personal opinion. I want to hear from you. What is your opinion and what's the rationale behind it? Put it in the comment section. We are a retail investment community, and we need to exchange ideas so that each one of us can get better. That said, in a world where the data lacks reality, how do you invest with confidence? That's the big question. Here are some strategies I'm considering, and I encourage you to do your own due diligence and share your strategies with me in the comment section. So first thing to do is to diversify across asset classes, stocks, bonds, gold, cash. Don't let any one policy sink your entire portfolio. Favor value and core stocks. When earnings compression hits, these tends to hold up much better. And defensive sectors are our friend. Think healthcare, consumer staples, and utilities. And I'm planning to stay nimble with fixed income. I'll reassess the duration and quality. We are still in a high rate environment. So I'm learning up about this, and I'll definitely share my ideas with you. But if you have any ideas on fixed income, please share it with me, because that's one area where my knowledge is very limited. Now, I'm also keeping the powder dry. I have plenty of cash, as I mentioned earlier. I've kept plenty of cash in the portfolio ready, and it will let us move when others are panicking. And above all, I'm going to be ready to revise my views as the data evolves, because I'm sure the data will. Now, in closing, I would like to say that economic data isn't fake, but it's not always timely. And in a world of real-time news and social media panic, that delay can be costly. As retail investors are at this flexibility, we don't need a board vote to rotate out of tech or into commodities. We don't answer to committees. But to keep that edge, we need to be aware that today's headlines are already yesterday's matrices. Keep an eye on the lag, stay agile, and always read between the lines. So that's the way I would frame my approach. So friends, thanks for watching this deep dive on ShareTreck. Let me know in the comments what signs of weakness or opportunity are you seeing in your country or portfolio. And at this point of time, I've already been crying bearish for almost 2.5 to 3 months now. And we have not seen anything bearish happen except for the steep drop that we had, which I think is a bear market which has started. And the rally that we are seeing right now, I'm thinking it's a bear market rally, which means it has got to fall down. And that's what I think it's starting to do with all the geopolitical tension and domestic political and structural issues. So that's the reason why I am bearish. And this kind of brings me to an end of the video today. I look forward to your feedback and your interaction in the comment section. Bye for now.